Eddie Ghabour is with us, owner of Key Advisors. You have been bearish, you've been concerned, you've taken a step back. How do you feel now when you look at the markets that also have had a tough year, a tough few months? We are at the highest levels since early June, but still well off anything notable in a good way. Yeah, not great.
Yeah, look, I'm still very concerned. I know this feels like this has been happening for years, but let's remember, it's only been 6 months, right? And these bear markets, which is what I believe we are in right now, it takes longer than 6 months to bottom out. And here's the biggest hurdle we have here near term, in our opinion, and why we're continuing to be extremely cautious for our clients is these second quarter earnings are going to be critical for the direction of the market here in the near term. We're going to start getting that data towards this next month coming up in August, and also some revisions. And I think you're going to see a pretty tough earnings season because of the inflationary environment, not only on the consumer side, but how much it's impact the bottom line of these corporations. Businesses are struggling right now because margins have been compressed. And so I think that we're going to take the next leg lower in the market when we see these earnings come out, because I don't think the average investor realizes how fast this economy is decelerating, but as well as profits. So it's going to be a very, very interesting quarter that we're going to start getting data on here very soon.
Yeah, and you said if the Fed's going to be raising rates, how aggressively, I don't know. I mean, we said at least 50% is what people, 50 basis points is what people were expecting. You might see 3/4 of a percentage point. I mean, maybe they might go rogue. Maybe they might do a full percentage point. But you said that would add fuel to the fire, not in a good way. You don't want to sort of hone in that inflation, rein it in, and maybe even cause a recession near term.
Yeah, and look, right now, I believe the Fed, because they're late to acknowledging inflation as an issue, now they're trying to play catch up. And that's a very dangerous game. When you have an economy that is slowing down as fast as ours is, and you have a Fed coming in and trying to tighten extremely fast and maybe do 2 years worth of tightening in a matter of months, that's when things can get disrupted. And look, all you have to do is look at the high yield debt market. The high yield debt spreads continue to widen. And that's very tough for companies that issue debt to run their businesses. So the more they put pressure on the bond market with their rate hikes, all they're going to do is make things slow even faster and potentially put us into a recession. So that's where you go from a softish landing to a crash landing. And this is why it's a very dangerous game they're playing right now with these rate hikes during this part of the economic cycle. So it's going to be interesting to see what they do in July and what they say going into September. If they continue to plan to just blindly keep raising rates during this slowdown, it's going to get a lot worse before it gets better.
Are you seeing any positive signs, anything that would say to you, hey, you could be a little bearish, you could be a little more bullish, you could put your toe into the water and bite on this sector or bite on this name because of cash flow or bite on, I don't know, something because it's been beaten down 50%. Is there anything you like?
Look, right now, unfortunately, not really, and I very rarely say this. Now, that doesn't mean as a long-term investor, you can't buy a quality company that's in it for the long haul, has good cash balance sheets. But my point is this: if we get a tough earnings season, we're going to get a broad-based sell-off. So that means the good companies are going to go down just like the bad companies. So I think if you're patient here, you're going to have a much better entry point in the next 3 months than what you will today. And that's our opinion, and that's why we have not bought anything right now.
So entry point in the next 3 months. So what's going to say to you, now is the time that I should start to get in?
So there's going to be two things. Number one is we need to bottom out from an earnings standpoint. I think second quarter earnings will probably be the worst of it in regards to how much of a change to the downside. So we need to just see a more of a leveling out versus deceleration. And I think that is going to coincide with a Fed that isn't as hawkish as they're leading us to believe in the fall. So that's why we're saying late third quarter, early fourth quarter. I think by then the Fed is going to change their tune because the economy is going to have slowed so much that they would have looked at it as they did their job of creating demand destruction and bringing inflation in a little bit. It's going to stay sticky, but that's why we have that 3 month or so target in regards to when we'll start dipping our toes back into these risk assets.
What were some of the names? I mean, you and I have been speaking a couple of years now, a few years. What were some of the names that you used to just always sort of go to as your winning stocks or winning groups that you're going to consider again probably when things appear a little better?
Look, I think the mega cap tech space is going to be a great opportunity because you're going to have some amazing companies that could be down 30, 40% from their highs, some of them maybe even 50 by the time this thing bottoms out, right? And then you look at the energy space. There's great dividend yields there, and that space is going to continue to have natural demand, especially with the supply constraints. So those areas right there, I think, are going to be places that investors can do really well over the long haul. And then lastly, I'll talk about small caps. I mean, small caps have also taken a beating. And a lot of times when you're in a market recovery, the small caps usually can recover first. So when we look at those three areas, I think there's going to be some amazing buying opportunities in those sectors in the coming months. And hopefully we'll be on our way up after that. But we got to get through this tightening cycle during a slowdown before we can be comfortable buying these very risky assets.
Yeah, understood. And I think Stifel was out saying they thought there may be a tech-led rally, maybe 10%, because of some of these. I mean, we've had a lot of guests who come on and have been picking Apple and Amazon and Meta and such, because a lot of these names have been beaten down. So I get your point. So mega cap tech, the group's been down. Energy demand is still there, and small caps. Those will be some things that you'll look at when the opportunity is right. Eddie Ghabour, nice to see you, owner of Key Advisors. Thank you.
Thank you.